I can. Yep. All right. Boom.
And before I forget, I'm gonna record.
Well, Jacob kicked us off on this topic, but CDC is relaxing its mask mandate. What does this mean for us? They're saying that once you're vaccinated, the odds of catching it are fairly low. The latest study I saw was 95%. And they're saying that these mRNA new style vaccines are effective against all variants of COVID so far. So the country is basically going to be opening up in late June. What are the short-term implications of this? What does this mean for us? Anyone have any ideas? Well, one thing was retail spending was up, and there's another slide on that, but people are spending more money. Automobiles right now are unaffordable. You can't buy a used car in this country right now for a reasonable price. And then, like we've been talking about the past couple of weeks, we're starting to see all sorts of signs of inflation, especially with shortages in the labor market. We're seeing a lot of fast food restaurants bumping their hourly pay to $18. So those are just some things. Any ideas from anyone about any shifts in patterns once the masks come off and life comes back to normal?
So my question is, do you think that the expectations of inflation, the rising of wages, and all that stuff is related to the CDC changing the policies with masks? Does it have any correlation, if at all?
I think my opinion on the inflation thing, I don't think it has to do with actually the economy overheating. I think it's more of like a delayed supply and demand issue. Obviously, going into last year in March, all the firms kind of cut down on their supply because they thought, we're going into recession, and people are going to be buying, all their stuff. So they cut down their supply, but then actually demand came back a lot higher than expected, causing prices to go up because now there's a supply issue. And obviously supply and demand takes a while to sort out. So I feel like it's more of like a delayed type of response here rather than people going out and spending a lot of money because of stimulus checks. But yeah, that was just my thought on it, I guess.
I completely agree with you that they're two separate issues, right? To me, the inflation isn't occurring because of the masks. The whole policy surrounding masks and things opening up is directly correlated with the vaccination rate. That's been the game plan once things got out of control. The inflation is a side effect of the supply crunches. So I do agree with Thomas 100% actually. Any other thoughts on this subject from anyone?
Yeah, I mean, I'm in full agreement with you, Thomas, as well. I think it's a supply chain issue. I actually put in really interesting data in the chat. Credit to the Washington Post. But obviously, we've seen a really, really sharp rise, but that is following a really sharp decline from last year. And if you adjust for that, prices are actually, yes, they're a little bit higher, but they're not nearly to the extent that it feels like at the moment. Really, prices are almost practically resuming to where they were right before the pandemic began. And so if you look at it from that perspective, it's not as big of an issue as it's kind of being made out to be. It starts to become more evident that it's more of a supply and demand issue rather than necessarily the economy getting too hot and us facing, the really nasty Carter-like inflation that I think a lot of people think about.
That's a really good point, Al. So my follow-up question to you would be, when you go to the grocery store, do you see signs of price increases right now? Not talking about gasoline. Okay, so
yeah,
all right, because I'm seeing the price of everything increase as well. Everything feels $1.20 more right now.
Yeah.
And
You see that price on hot Cheetos? killing me.
But like we're talking about all this supply shock, all these companies such as Procter and Gamble, they're trying to raise the prices on all their products now because everything costs more, including building a home.
Yeah.
If you were building a home right now in Seattle, your budget is in shatters because of the price of wood. So it is interesting, and everyone needs to keep an eye out for this stuff and be ready to come up with some strategies for when inflation hits for reals. So part two, follow up to this. There's some pretty interesting graphs that I found. So the Commerce Department released their retail sales report on on the 14th, I believe, and it shows right there. You can see in March that spending exploded. There is some debate on why, but I think it's definitely correlated with the stimulus checks. And then things kind of went down things did go down in April, except for automobiles, which managed to stay positive. So what does that mean? Is the recovery over? Are consumers going to be more conservative in the future? Are businesses going to be having an active summer, the summer that they thought they were having? And there's some really interesting statistics associated with all this that I pulled up, just so y'all can see. The report looks like this, and it comes out every month. And I thought the most interesting aspect of this report was this paragraph right here: retail trade sales down 0.3%, but up 46.1% year over year. And clothing and clothing accessories stores up 726% from April 2020, year over year. And while food services and drinking places are up 116% from year over year. So last year was really awful. Like Al was saying, comparatively speaking, things aren't necessarily as bad as we're making it out to be. But it's some interesting implications. Any thoughts on any of these graphs from anyone?
I not necessarily. The graphs are great, but something that kind of weighs on my mind regarding all of this is, I think Chris mentioned earlier, lack of. We're running short on people as far as filling certain positions. Like literally, like I went into Burger King this Saturday morning to get some breakfast. It's like 10 a.m. and they're closed because of staffing. Like where I'm at now, we're hiring 6 people. People are like, I don't know what kind of, we're going through something that I've never really seen before. And that's a trend where people are getting the attitude, well, I can make more money just staying at home. But what will that do in the long run as far as our economy? And even when things, inflation happens and prices go up, well, what's going to be the outcome if we have these corporations that can't make money?
There
Because
is a lot of uncertainty.
yeah, it's
And
weird. Like
yeah.
like I give you an example, like my company, we just bought $11 million worth of business, but we can't find anyone to do the business or take care of the business. So it's like, that's scary. That's
Right.
Quite frankly, it's the government basically has inflicted this upon themselves. They started paying people for unemployment more wages than the what's it called, the minimum wage. So people are not incentivized to work. Why would they work when they get more um, more money by filing for unemployment and not working? Who would want to work?
right.
Similar things is happening in course with the inflation as well. If they're if they're really paying people to stay at home for unemployment, yes, that's going to extinguish the fire that's right in front of them. But really, that's such an excessive way to extinguish the fire that the aftermath is so great.
And like we talked about last week, landlords, small landlords, are in for a reckoning whenever the shoe drops. So I don't know. These are all just things to keep track of. It's important to monitor all the monthly reports, employment, labor statistics, blah 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 blah. But it all provides a macroeconomic perspective, and it'll all help you with your analysis. Okay, last thing I wanted to talk about. None of us were here for the OPEC oil crisis of '73, but that's Portland
sure?
right there. No, yeah,
Just kidding.
I took a look around. I feel pretty solid making that statement. But imagine if you couldn't get gas in the country right now, what chaos there would be in the immediate 3 to indefinite days. And it happened for reals in '73. And they did all sorts of things to try and curb gas consumption for a year. And I want to say it was certainly a contributor in Jimmy Carter not being able to win his reelection. So Colonial Pipeline, we briefly talked about it last week, but they had a hacking attack where they were basically held ransom from some sort of cyber gang based out of Russia, not associated with the Russian government, but they're based out of Russia. They were extorted for $5 million in cryptocurrencies. The attack was successful because there was no separation between pipeline operational data and administrative data. It was all one data pipeline, which put them especially at risk. And let that be a lesson to all of you. Data infrastructure is incredibly important. So basically, the Homeland Security came out and said that if they couldn't wait 3 or 5 days with the Colonial Pipeline shut down before infrastructure in the eastern seaboard would start taking a hit. So they were responsible for all the jet fuel, a lot of the diesel, a lot of the gasoline going all up and down the East Coast. And as the details have come out, it's been a pretty amazing sort of incident because it showed how vulnerable a lot of our infrastructure, including private businesses. We always like to joke that the public businesses, the government is what's lagging, but really it's a lot of the private industry as well. So just wanted to talk about this a little more, see if anyone had read up on it. We're not too exposed to the oil industry, but what sectors do you think would be exposed to something like this? If we had gas shoot up to $12, $24, $30 a gallon for a week, what do you think the consequences would be? Anyone, take it away.
I feel like almost all businesses would be affected by this because mainly a lot of the like goods and services really require like transportation, which requires fuel. I feel like software companies won't be hit as hard, so I feel like it'll be kind of like a safe haven. But that's my opinion. Other than that, but on a side note, like so this industry is like $181 billion industry, but they only or the hackers demanded like 5 million, which is pretty surprising because it's like $1 billion industry, but could have got more. I don't know, but
yeah, it definitely almost feels state sponsored at that level, right? They're not doing it. It's not like that big a heist per se.
sure.
Yeah. So that's a very interesting point. I hadn't made that connection. Thank you for bringing that up. What about using the cryptocurrencies, huh? Pretty slick. The Dogecoin.
That's true.
Any other thoughts on this?
Tesla.
Yeah.
Yeah.
Right.
This one was interesting.
Right. So I don't know if everyone follows Tesla, Bitcoin, but Elon Musk basically came out publicly against or divested Bitcoin from Tesla, and then Bitcoin has crashed.
I think he mentioned he had, or Tesla hasn't sold any Bitcoin.
Oh,
Yeah, but they could have sold it and then like tweeted afterwards, like, "Oh, we're not selling any Bitcoin."
or
That's up for debate.
It's something that fluctuates that much after one action and one person's tweet really worth, or
Yeah,
can it really be a currency? Should it even be called a currency?
his tweet was just a comment, right? Just indeed,
Yeah,
and then just
exactly.
started crashing.
Yesterday it hit bottom of 44K, I think, something like that. Considering that it was
Elon's-
almost 80 the other
Right.
day, like a week ago.
buy the dip.
Buy the dip.
By the way,
Classic.
before we end the discussion on the colonial pipeline, I wanted to bring up something related. We kind of touched this, the price of wood. We kind of touched on the price of oil. In case this happens, and because firms that operate mainly on wood, mainly on oil, can't really afford to buy wood and oil at an absurd price, they go through something called, does anyone know the term? Hedging. They hedge the price. They tend to lock in the price. There are markets for this, usually called commodities futures. I think the best way to explain what I want to explain is by paint, and you guys will get to see my beautiful drawing. So cool.
Let's go. Put that Wacom tablet to use.
I tried using that and it did not go well. I used it for like 5
man.
hours and I
Did you use your mouse to spell out price?
I'm using my mouse.
That's not bad for your mouse.
So
I've seen worse.
let's say we are in May here, right? So May, June, July, August, September, October, so on. Well, let's say the price is about here. I'm not like assigning any values to the price. I just want to catch the trend. Let's say in the case that the colonial pipeline the situation has been prolonged and the price just shoots up like this. A company really cannot afford this much of a gap. So what they do is they hedge. They buy in the price of this and then sell a forward for this price. So they can lock in this price, and even though the price shoots up this, they already had the forward contract locked in, so they don't have to pay. Now, the buyers, in this case, the companies who use it, are not the only ones who wants to hedge. Let's say a price follows this trend. Now the company who consumes oil has no need to hedge against the price. But then who would have to hedge in this case? Who's on the other side of the companies who use this?
The firm selling it.
Yes, the firm selling it, or the firms, or the producers, so to speak. So because they can't afford to sell it at a lower price, they're going to hedge on this price. So even if the price tanks, they can still sell it at this price in the future. And this is basically how the commodities futures work. The point that I wanted to make is that this hedging happens a lot. Airline companies hedge the gas so that even though the gas prices shoot up, they can still afford the gas at a reasonable price. Lumber companies will probably hedge the cost of lumber, even though the price shoots up, they can still operate without bleeding too much out for cost of goods sold, and so on. So this is something that you should consider in your valuation when you deal with the materials or industrials and the prices of the materials or industries that they are operating in shoots up. How much have they hedged and how much they're bleeding? If they haven't hedged, or even though they have hedged, they can't perfectly hedge. They might have to hedge at this point, so they're still losing this much of a sliver, and how much impact that has on their company. Those things do have to be considered. That was my little drawing with derivatives.
I think that's the most clearly that concept has been explained to me ever.
I'm glad.
Yeah, I knew nothing about it until you explained it now. So thank you, appreciate it.
So moving on to the next section of the market news, I have asked all of you guys to kind of pick up a topic or two to discuss related to the topic or the stock that you have been assigned. Has anyone prepared for it and wants to go first?
I can kick us off. So I have been doing some reading about corporate tax rates, and it sounds like there is a growing push around the world to sort of pass some sort of global corporate tax, because the pattern is that companies will store IP or any non-tangible valuable thing in a country with low taxes, and then siphon a lot of their money there, or record it as earned in that country. But it seems like there's a proactive cracking down of this subject, including the United States. And if the United States can't work with other people to get it passed, they'll do it themselves in-house. Because Biden's very, so that was something I read, and I thought it was very interesting.
So that's a good topic to start us off, corporate taxes. What do you all think about the current government's stance on increasing the corporate tax? Do you think it will help the country out, or do you think it's going to hurt? We can literally make arguments both ways on this.
Yeah, I think right now the two things that they're debating on is obviously Republicans don't want to increase it. They instead want to go through what would end up probably looking like a gas tax, so tax on consumers. And then really it hinges on Joe Manchin. I think was it 125% was the highest he was willing to go. Initially they wanted 28%. So it's really that's probably gonna be the limit in terms of how much they can raise it. And then it's gonna be just a question of where they can go from there. In terms of how will it help or hurt the economy? I mean, if corporate taxes go up a lot, obviously that's good. That's going to cool down the economy a little bit. That being said, I don't know. Personally, I hate the idea of a gas tax. That's the only thing I have against that. I hate consumer-facing taxes in general. So that's that. Gas taxes piss me off. So whenever I hear that, I just get angry. But we'll see where it goes. Realistically, it's probably going to be up to Joe Manchin, as per usual. But I don't think a small increase. It would just that'd be a 2 or 3% increase. I don't think that would be too big of an impact. But I don't have enough information to talk more onto that. In addition, just kind of wanted to bring the news forward.
Cool. So when the corporate tax is collected, what is the most important thing that we should look at after that it's collected? Or what do you think is the most important thing we should look at? So once the tax is collected, then what does the government do with the tax?
I'll go ahead, Bridget.
I mean, they should. I'm just guessing. It should go back into like infrastructure and things
Correct.
like that, like fix
Correct. That-
highways and
You're 100% right. That is like the exact thing that we should look out for. When the corporate tax goes up, we should see whether the spending on infrastructure, spending on technological development, those things should be increasing because, quite frankly, United States currently has the highest power in the world. It is the most developed country, and capital deepening, which basically is throwing money, cannot really improve the quality of the labor anymore. To improve the quality of the labor in the United States or any developed market, there has to be technological improvements to how the things are being done. Giving more money to people, let's say, um, let's say that you're a minimum wage worker in a grocery store earning $3,000 per year. If for some reason the minimum wage increases to 50,000, will you really improve the quality of your work by that much? Or if your wage doubles, can you really double the amount of the work that you do? You can't. There's a limit to how much you can improve. But with the development of technology, that's possible. With the development of technology, even though your wage stays at $3,000 or $30,000, you will be able to do much more or more efficient work because of that technology. So in a developed market, the only way to really increase the total productivity is to increase the technology. This, by the way, is straight out from economics from CFA level 2. So that's something that you, if you are planning to take in the future, that's something that you should know. So with that being said, totally, we should really look out for spendings in infrastructure and technology if the corporate tax increases. But there's a huge but. But what if we don't see that? Then what does that indicate?
Business as usual.
Businesses get taxed more, infrastructure spending on infrastructure stays the same, which means the total productivity stays the same, but corporates are getting taxed more. What does that mean for the economy? Or what does that mean for the labor market?
Goes down.
Labor market goes down, economy goes down. So it's a double-edged sword. The government really has to know what they're doing, how they're going to spend that increased amount of tax for that to work. If not, they're better off not doing it at all. Anybody else? Next news.
I can go next. I can talk about my stocks, Google. So Google, it's of course like a big company, so I don't really know where to start, but I can start with something exciting. So Google I/O conference. It's like it's like the W something from Apple. It's an annual developer conference. Will be happening tomorrow at 10 a.m. So Google often use this space as a like to just announce this major versions of Android. So we would expect Android 12 to be talked about tomorrow. And there's a couple of more stuff like Pixel Buds A series, the wireless headphone, or like, yeah, something. Oh, you have a Pixel out. So the Pixel but A series that was unveiled accidentally early this month on Google social media already, but I think they'll be talked about officially tomorrow. And also they will talk about the customer processor for Pixel. So Google has developed a custom designed systems on chip. So it will be the company first first chips for its own products will be discussed tomorrow. So that's the three main things that was expected to announce tomorrow. And Google has a reputation for being unable to keep like its product secret. So probably, but it could be different this year because the conference was canceled last year. So that's why I'm super excited for the conference tomorrow. In terms of the fundamental analysis, Google for the latest earnings of Google is in March, and the revenue grew 32%, with the earning per share more than double. And also Google will benefit from the increased advertising, of course, on Google platform, on Google search engine, and on YouTube. And Google, and so in terms of the balance sheet, Google has more cash per share on the balance sheet than Microsoft, Apple, and Google, Microsoft, Apple, and Facebook. So I think I could be able to talk more about it in my valuation, but that's just a quick snapshot. A couple of risks related to Google is definitely the antitrust and the lawsuit with the Justice Department because of its of course its antitrust with Google search engine, and there could be a possibility that the Justice Department may ask Google to break up its business, which means that Google have to spin off YouTube to independent stock. But a lot of places that I've read online, a lot of investors really love the idea of Google being broken up because it could create value for shareholders. I am still looking at it and see why it could be valuable if like big tech like Google or Amazon, if it's spin off. So that's the major risk related to Google. And one more thing I want to talk about is that I have always personally have always think about Google as a internet company, or more like advertising internet company. But after looking at do more research, I realized that Google has also had the moonshot factories, which they are doing a lot of moonshot and secret projects, the most famous one is probably the Waymo, the full self, the autonomous driving, but they also have a couple more like Leons and classes and stuff like some crazy stuff that I think would be beneficial to Google in the long term. So yeah, that's my quick snapshot of Google.
Thank you, Dee. That was great. I do want to bring up a couple of discussions on this topic. So first of all, to compare tomorrow's Google's the market release. So recently Apple released their new what's it called, the announcement of new products. They had a game changer on the what's it called, the tablet, the
Microchip.
iPad. Yeah, the iPad, they were able to put in a M1 chip, which is a computer laptop chip, into a tablet. So people are imagining that to be a really good or a very positive change in the tablet industry. And still, after that, Apple's share hasn't really gone up that much, which could either mean that their announcement hasn't really impacted much on the Apple's value, or people don't think that tablets are that valuable, which I feel like in a current situation, I'm tempted to interpret it more as the former, because the technology of CPUs, even in mobile, has been up so high that a more upgrade does not provide that much of a marginal difference. So how much more difference will Google be able to get out from this announcement tomorrow, when Apple has failed to do so like a month ago or a couple of weeks ago?
I just think it signifies a new level in the tech industry, right? I think COVID really highlighted the stress on the supply chain in terms of computer chips, not just for Google and Apple, but for even car manufacturers. So, and it really seems like everyone is going down the route of designing their own chips, or making their own chips, or contracting someone else to make their own chips. But it seems like there's a lot of attention now on microchips because of COVID, indirectly because of COVID. But it'll be very interesting to watch.
I always think of Intel when we talk about microprocessor processing design, because Intel was probably the biggest chip manufacturer in the past, and with the trend that a lot of companies and cars and stuff trying to make chips on their own. I know that we have Intel in our portfolio, so that's just something that I think is interesting to see. And Intel has missed a lot of deadlines for new products and stuff, so that'll be interesting too.
Yeah, my company here as well, Microsoft, is also looking to to have their own silicon chips. Obviously, Google is as well with the new Pixel phones. So yeah, like Joe mentioned, people have been talking about, yeah, companies are really making that move towards having their own silicon. A lot of time, I mean, for a while, it was really just you had Apple and you had Qualcomm, and then Samsung was out in the corner like a sad child because their chips were really bad for a little bit. So you really just had those two choices, and one of them isn't a choice. So you just kind of went with Qualcomm, and I think a lot of them got tired of that. And I think they also see what Apple can do. I don't use Apple products, but I really respect it. I've been following for years. They have they have like a wall garden that's just insane. And if you look at the way they conduct business, oh, you know what? MKBHD did a video on this. It's the exact same topic. But for example, Tile, you might be, Tile, the trackers, right? You can track your phone. Apple obviously released AirTags, does exact same thing. And for a while, the whole claim from Tile is that you can't go more than like 5 blocks without encountering another Tile user. But now that kind of goes away now because a lot of people are going to move to AirTags, and AirTags gives you the opportunity to come into their ecosystem. Like you could technically, if you're Tile, you could add your product into the Find My ecosystem, but then you're just empowering Apple's ecosystem and then worsening your own ecosystem because now your tracking service becomes inferior while you help build up Apple's tracking service because you've entered their ecosystem. And if you decide not to do that, well, then you're just going to sit there with your own ecosystem, which is going to become less and less popular and eventually die off. And they've done that with so many different products where they can just enter a market and immediately capture and destroy it by waiting for someone else to come in, being like, I'm going to copy your homework and change it a little bit, and then go on to dominate it. All right. And whenever there's a player that has enough power, like for example, Beats was like it was a product that felt a lot like an Apple product in the sense that it had that popularity to the brand level to it. And Apple bought it pretty much purely to kill it off. They never use the brand. I mean, they still make Beats. They don't really do much with it. It just kind of sits up there. They bought it mainly purely so they can just sell AirPods. And now AirPods, if you just take AirPods from sales alone, I think it's like one of the top 15 like richest companies in the world. If it was just a company selling AirPods, like that's how ridiculous the income is from that. And they're also really good at creating a problem within their own company, within like the iPhone brand, for example, and then creating a solution and then selling that to you, whether it's dongles, whether it's getting rid of the headphone jack and selling the AirPods to begin with. They do such a good job at that. And because they have such a lockdown ecosystem, a lot of it powered by their own chips, they can make so much money from it. And I think a lot of other companies like Microsoft and Google see that, and they want that integration, that unity between all these different products. And they want to slice of that because once you create that walled garden, iPhone users don't switch to Android very often. It's not heard of because it's so hard to do. Because you have all these ecosystems, and if you switch to Android, it no longer meshes together the way that Apple intended to. And Apple won't let it mesh together. They could easily make a iMessage app for Android, but they don't. And they've had that discussion intentionally every single time. They say, we're not doing it. Why? Because they benefit from Android users having those green bubbles because they want that walled garden. So it's really interesting to see, and it's really interesting to see other companies chasing that because that walled garden is something that I've respected. I hate it, but I've respected it for so long. Interesting thing to think about.
I am right with Al. And whatever Apple does becomes the industry standard, regardless of whether it's a good way or not. They removed the 3.5 millimeter headphone jack, which has been extremely frowned upon. Apple did it. Everyone else does it. Samsung made fun of it, took down the ads that they made fun of it, and did it themselves. Apple started not giving out chargers. Samsung made fun of it, made ads making fun of it, deleted the ads that they made fun of it, and then copied it themselves. When Apple does it, nobody criticizes them. Just becomes the industry standards. Every way they can cut the margins or make the margins by cutting either quality or making a problem, they'll do that. And they increase revenue by selling the solutions to the problem. In a business strategy term, this would be called economies of scope, different from economies of scale, which you get cheaper products by buying more. You have a scope of customers, and then you keep bringing in them into your scope to raise the revenue. Either way, cutting costs or increasing revenue will get your operating profit up.
I wanted to mention this, but does anyone, this is where I had this realization the first time I realized how much of an impact they have in industry as a whole. I remember going to class one day. I didn't have an iPhone, obviously. I still have an Android to this day. But walking to class, everyone was talking about this new iOS update that changed the way the phone looked. It was the iOS 7 update. It's when they went from, before companies used to go for this 3D look, and they switched to flat. And I remember within months, every company started updating their logos, their icon. It stopped being like this 3D fancy look and being flat. Windows went from having, remember like Windows 7, tried to be glossy and fancy, it went to flat. Everything moved to that design. And I feel like that, at least that felt like the trigger at the time. But it's just so interesting how much power they have over, I don't know, the world, the industry as a whole.
Well, I would argue that Apple does spend the most amount of time and expertise focusing on design of everyone. I mean, most of their products are just built to look really good. And the metal laptop, it was so they do certainly set the UI standard. I do see that.
I think we've moved way too much on Apple when our original topic was Google. So let's get back on Google. Anyone else?
I just want to add a quick point regarding to Apple. I feel like I still have hopes in Apple just because App Store, like at first App Store was not intended to be, to include a lot of outsiders or like outside developers. But one of the chief at Apple, specifically Scott, he was a CTO of Apple, and he argued with Steve Jobs to make App Store more available to outsiders or like outside developers. So I think that would be a way that Apple could move away from being monopoly in the near future if that happens.
So let's try to move away from Apple and talk about Google itself. I think the best way we can try to make that transition is talking about the antitrust law that we mentioned. So back when Trump was still a president, I think it was around November 2020, Amazon was stricken, or Google has been hit already. Amazon was in the verge of being hit and getting their business split into Amazon and AWS. Do you think, with now Biden being the president and the Democrats being the majority, do you think they will keep chasing after the big tech companies to split up? Or do you think Google will be forced down to split between, I don't know, Alphabet, Google, and YouTube?
What is the question, Chris? Sorry, I missed that.
Do you think they will keep the current government will chase Google to split into different companies, or no? Do you think they will stop?
I think even though Trump is no longer out like president, I'm not sure about Biden perspective on that, but I know that Senator Elizabeth Warren, I believe she's in the House Judiciary Committee.
Right.
She is in line with Trump's regarding the power of big tech. So I think that would be something that the House be pursuing.
The point that I was trying to make is that even though Trump was a Republican, he still went ahead for the antitrust, and the Democrats were already very hostile against big tech companies being a big tech company. So they are more likely to chase them down. Do you think within the near future, Biden administration will do something about this?
I feel like for the near future. Oh, go ahead, Al.
Oh no, you're good. I was just gonna say that I don't see it. I don't see it happening. I think there have to be a lot of political will behind it and then a majority behind that political will. Um, and especially with the current system, I don't see it happening. I can see social media before, for Republicans retain power. I could see maybe some social media companies, I guess like Google, I guess like Facebook, maybe Twitter, having to deal with some force from Republican Party, or in another world where maybe there's some political fire that lights up on the left side. I could see Democrats also doing that, but I think currently, if nothing else occurs, I don't think the status quo is going to change much.
Oh yeah, and I totally forgot until Kathy posted that Google actually their stock price went up after the antitrust lawsuit, and we were trying to figure out why.
That's so weird.
Mm-hmm. So I mean, all in all, I feel like that just makes it so that at least the investors don't see it to be a huge threat to Google. Thank you, Nee, for your market sharing your market news. Um, who wants to go next?
This is random,
Mhm.
and probably just gonna be a very short topic. But for a long time, or like basically last year when the whole unemployment thing was happening, I was really in the belief that we should have basically had pay vacation time um, until the end of COVID, and then have the government subsidize that. Because I was worried about basically the issue of unemployment in the end. Is that feasible, or I don't know if anyone has opinions on that, but I I don't know if that would work.
I'm not too familiar with that to have a definite opinion on it. Is anyone else familiar with it?
Are we talking about paying people to stay home?
No, it's probably not a good topic to bring up. I apologize. I was just talking about. Yeah, it was more like an opinion piece, so it doesn't really make sense to talk about. I'm gonna close it. But
All right.
all right, move on.
I'm just gonna call on someone. I guess Thomas, you mentioned that you had some news to share, so I'll.
Yeah, I didn't really have anything too much sector related. I was actually just reading about AT&T and some merger with Discovery Media, but I haven't read too much into it, so I'm not really sure the details about that.
Got it. So
But
I
there
think
wasn't really
it's,
there. Go ahead.
I think it's really interesting how the phone carrier has become so large, and they with the integration of 5G network, they try to bring in the television channels or makers of shows to cooperate with them so that they can offer better service to people and have them come into their network. I think it's a very interesting trend.
Yeah, I think it's just a part of their product differentiation. Again, like having T-Mobile versus Verizon is pretty much the same thing. So if they can offer like Hulu or like ESPN Plus with that, then maybe you're more likely to choose like Verizon over somebody else. But yeah, it's interesting like why they're choosing entertainment services with that. But yeah, it's definitely interesting.
Kate, you raised your hand.
Actually, that news that Thomas just mentioned relate to the company that I'm gonna do the valuation, which is Netflix. So the news just out today, and they say that they would acquire the Discovery company to compete with Netflix and Amazon in the next 5 years. Uh, but in my opinion, I think Netflix still have competitive advantage in its demand because they have a huge loyal customers and with the original content that they are trying to, um, and also they have the global market compared to Disney Plus, because I know that even though Disney Plus have like international market, but they have difficulty in doing subtitles for their movies. Um, while like Netflix have available subtitle for many languages, and also um, they already have like 208 million uh, subscribers, and like with a loyal amount of subscribers, when they have new TV show or new seasons, like they will keep like following and paying the monthly fees.
Yeah, definitely. And I think this brings up back to the topic of economies of scope that we mentioned with Apple. There are a few companies that I associate with that. Apple obviously is one of them. Starbucks, Netflix, those big name companies that we think of when we think of a particular service. When we think of coffee, we think of Starbucks. When we think of a streaming service, we think of Netflix. I think those companies have the advantage of bringing customers in to their scope. I do think that that's because they have the competitive advantage. But then that's also a talk of whether chickens came first or the egg came first. Do they have competitive advantage because they have economies of scope, or have they earned the economies of scope because they had the competitive advantage in the first place? So that's, yeah. But I
Yeah, it
100%
came
agree.
first. Just so we're all clear.
Well, in this case, yes, Netflix gained the competitive advantage first, and then they acquired the scope. So, but you know,
Well, I do think this piece of news is really interesting because AT&T owns HBO Max or HBO, and Warner Brothers is its own company, right? That's totally separate.
CNN.
CNN, gotcha. So it's pretty big news, and I guess you have to have that economy of scale in order to effectively compete against a behemoth like Amazon or Netflix. No, CNN belongs to Ted Turner. That's the guy that created it.
So what's the relation between CNN and Warner Bros. That you mentioned?
Oh no, that was me getting it confused. That's
Okay.
HBO and CNN are going to be merged or are being divested from AT&T. All right, who's got the next piece of news? Anyone?
I could go.
All right.
As you guys might remember, I presented on FedEx. And since my presentation, I would probably want to emphasize a couple things that have happened. One of them is UPS. They're rivals, they're competitors, but basically operate in the exact same business as FedEx. They reported earnings and they way beat expectations, which is a positive thing for UPS, but also kind of was like a positive thing for FedEx because it kind of was like a anticipation of like, okay, how much has e-commerce really like pushed sales for like UPS for FedEx this shipping. So that's kind of raised the estimates of, or like the expectations for their Q4 earnings, which I think are in June. And then more recently, this is kind of relevant too, because when I presented, Kathy asked me about their acquisition of ShopRunner, which is kind of FedEx's initial move into the e-commerce space. And just far more recently, so I think like a couple weeks ago, FedEx announced their partnership with Adobe. And their idea here is that by partnering with Adobe, Adobe will help them integrate their ShopRunner sort of business. Because part of Kathy's question was like, okay, FedEx, they don't have experience. Like, how do you expect them to be able to integrate something like ShopRunner when it's something they're unfamiliar with? but they've worked on this partnership now with Adobe that's going to allow them to like use Adobe's expertise to integrate ShopRunner into FedEx's businesses, while FedEx also is going to help Adobe by providing these these shipping services and these logistics networks to Adobe in return. So that's something that's definitely interesting to me, just in terms of it's like they're like doubling down. They're really showing that they care. They're trying to go for this e-commerce investment, and it also kind of plays into like this competition that they're showing. Like, all right, we're going up against UPS, we're going up against Amazon as well, because at the same time, Amazon's constantly trying to like bully their way around in this space as well. You know, have their own delivery system as well. So that was a big move, I think, for FedEx, and it's promising for their e-commerce adventure, I would say.
That is two names that I didn't imagine together, FedEx and Adobe, but that makes complete sense after you explained it. Like I feel like that's a good move. And the point that you brought up about how FedEx can provide the service of transportation and Adobe can provide the service on software, like definitely makes sense. The integration of those two businesses will be powerful.
I'm happy to see FedEx doubling down because competition is ultimately what's going to make the sector more efficient and provide better services, quality of services, as well as pricing to consumers. So I'm glad that FedEx is still in the fight, because if FedEx isn't there, it's just the Postal Service, UPS, maybe some small international carriers and whatnot. But it's important to have that competition.
Yeah, definitely.
Mm-hmm.
Yeah, I think it's also strong because it allows them to become a player, kind of like how Amazon's shifting from their e-commerce towards delivering so that they have that end-to-end business. FedEx is shifting from just like delivering to having the end-to-end business as well, from e-commerce to shipping. So it gives them that advantage there and saying like, all right, we can also do that, Amazon.
Cool. If we don't have any more news to discuss, I would like to move on to our second part of this meeting, which is the valuation training that I've prepared for you guys. As I mentioned, I'm going to be asking a lot of questions, so please be prepared to answer. But before I proceed, any more things you want to discuss? Nope, okay. Not taking any criticisms on design. I was out of time. So let's jump right into it. So the most commonly used intrinsic valuation method that we use is free cash flow to the firm. Then we all should know the formula to reach free cash flow to the firm. Can anyone tell me what it is? I'm going to be writing it as we go. Anyone? This should be one of the easiest questions on this slide. Literally, you've done this multiple times.
It's net operating profit after taxes minus investments during period T.
What does investments? How can the investment split into two pieces?
CapEx, change in net working capital.
Yes. What's missing?
Depreciation.
Exactly. And I'm going to be and I'm going to bold this depreciation, and I'm going to bring it up later. What discount rate do we use for free cash flow to the firm?
Weighted average cost of capital.
Yes. Why? Why don't we use cost of equity, for example?
Because we are not free cash flow to the equity, we are doing the free cash flow to the firm.
Right, but why does then free cash flow to the firm use weighted average cost of capital and not another discount rate?
Because we are looking at the firm level
Mhm.
and industrial level.
Well, yeah, that is very close to the answer. So I guess my other question is, what is free cash flow to the firm measuring? Like, what are we trying to measure by calculating free cash flow to the firm?
The firm's operating cash flow, like the
The operating cash flow is this part, no,
yeah.
this part. By taking out the expenses, what are we trying to measure? The free cash flow that is available to who?
To the shareholders.
That would be free cash flow to the equity. What are we measuring in free cash flow to the firm?
Or the okay, I will let someone
answer. There are two parts in weighted average cost of capital. There's cost of equity and cost of debt. Free cash flow to the equity measures the free cash flow available to the equity holders. What does free cash flow to the firm measure then?
Debt.
It would measure the free cash flow available to equity holders and debt holders.
Debt holders, yeah.
So all sources of capital. That's free cash flow available to all sources of capital of a firm. That's why we use a weighted average cost of capital, because we are factoring in both the equity holders and debt holders. Why would we use free cash flow to the firm over free cash flow to the equity? Then? Why would we want to do that? If what we are interested in is the price of equity, why then do we measure free cash flow to the firm and not free cash?
Because some companies are heavily leveraged, like that has a lot of sun's in it, I would say. So we have to look at if they're able to meet their debt.
Exactly.
Or not.
What there is another reason behind using free cash flow to the firm over free cash flow to the equity, and it also has to do with leveraging. Does anyone know? I'll take the silence as a no. When the capital structure changes dramatically over 1 year,
Over time,
over a short amount of time.
Okay.
In this case, free cash flow to the equity will not provide an accurate measure.
In what situation would that happen? For example, if the company is in a mature cycle, would it be like capital structure wouldn't change dramatically, right?
Right.
Like,
correct.
If
correct.
you can give an example, which company would be in that group of like changing capital structure?
I'll give you one really good example.
Is it Starbucks?
Yes. You see, fiscal year 2019 long-term debt is 11,167. 2020, it doubles. That's the change of capital structure in 1 year. It literally doubled in long-term debt. So in this case, you will not be using free cash flow to the equity.
Makes sense.
Right. And Kathy's explanation on that helps too. Sometimes it's hard to predict that level. Like especially like in Starbucks, we only had one number to anchor from and to predict. But then we later found out that those that were restructuring. So that's another part of the answer. If a firm, even if it's mature, goes through a restructuring and has to take debt for the restructuring cost, that will also alter the capital structure. Let me share back the. Cool. So let's start with net operating profit after tax. I've provided a pro forma income statement for Starbucks here. Let's calculate the notepad for fiscal year 2020. The information that you need is all on this slide, I believe. The tax rate that we use is going to be 20.59%. Let's try to calculate the that operating profit after tax. I'm going to call on someone in about a minute to see whether they have the answer. If anyone's done, can you tell me that you're done?
Chris, can you repeat your question, please?
Oh, can you calculate the net operating profit after tax for fiscal year 2020?
Okay.
The tax rate that we are going to use is here 20.59%. Anyone done? Did anyone have a number? Yes, no, maybe?
I got 924 for the
Right.
gap. I didn't
Right
do
on the
adjusted.
Right on the money, yes. So the way that you will get it, as you can see, you see two pre-tax income numbers. One is adjusted and one is GAAP. GAAP is generally accepted accounting principle that the US follows. I think the only country that follows GAAP is the United States, but most of the stocks that we deal with is US based, so you'll be working with the GAAP number. So from the GAAP number, pre-tax income GAAP, you'll be taking out the tax. The income tax that we have used here is 20.59%. So taking out 20.59% of 1164, we'll get 924.65. That would be our net operating profit after tax. The next component that I want to talk about is the capital expenditures. So what is
Chris,
capital?
Sorry for the interruption. Could you please go back?
Yes.
And maybe it would be nice that you can print out, you can type in the numbers in the note. So
Yes, that would be great because saying it and seeing it at the same time is great.
In the note or so go down to, let's see.
I'll use a text box.
Yeah, sure. Thank you.
Cool. Pre-tax income GAAP was 14.4. Tax rate was 20.59%. So our NOPAT would be 1164.4 times 1 minus the tax rate, which is 924.65. Let's move on to capital expenditures. Can anyone give me a definition of capital expenditure? It doesn't have to be like, long, accurate description, just a short like right on what it is or what it's trying to measure is fine.
It's
Go
the
ahead.
funds used by the company for maintaining the property and asset.
It's on the right track, but they're right. It's well, I'll give Jacob a chance to answer, and then we can go from there.
Like if a business or a company, it's the expenditures on like physical assets like machines, equipment, so that they can basically conduct their business.
Yes, exactly. And those tend to be longer term. So this is investment that a company makes to do their business in a longer term. Basically, usually property, plants, and equipment. Usually. It doesn't necessarily have to be PP&E, but it usually is the investment in PP&E. So what's the significance of capital expenditure then? Why is it important?
So basically it tells if they have enough capital to invest in that new project or for the business in general.
Right, exactly. Measures whether the company can afford, and what happens if they don't, or what happens if even if they have the capacity to do, but they don't invest in that. What happens?
I mean, you are asking in terms of investment, or
Yeah,
they basically don't invest.
like what happens if a company doesn't use much money in capital expenditures?
That
Like,
means they don't invest in their R&D.
Right. It means that they're not investing enough in their longer term projects. So
Yeah.
is that really a good thing or a bad thing?
Bad thing?
Well, technically it can be interpreted either way. Can make an argument that less capital expenditure is good because it prevents them from trying to spend too much on a useless project, or what could be useless. Or sometimes investors think it's a good thing because a company needs those to invest in a future technology or property plants equipments that they need. So it could be mixed outcomes. I think as Peter Browse, one of the professors, would say, about 50% of increase in capital expenditure brings in an increase in share price, and about 50% brings in decrease in share price. So I guess it really depends on situations and industry company is in. But the significance is that company invest in the future by investing in capex. And that brings us to depreciation. And what does non-cash charge mean? So we all know that depreciation. We all know what depreciation is. It's the amount of the value loss that happens in the property, plant, and equipment as we use them. But then, what does non-cash charge actually mean? Does anyone know what that means?
That means it reduces the earnings, but it doesn't do anything for like cash flows.
Exactly. It has no impact on cash flow, but it decreases the earnings. And why does it have no impact on cash flow?
Because that cash was already spent?
Is it really spent?
Depreciation doesn't involve a cash payment.
Right. When an equipment gets older and loses value, who do we really pay to then? We don't really pay it.
We don't really pay to anyone.
Yeah, when we like, for example, when you're a watchmaking company, because I really like watches, you buy steel, you pay check for the steel that you bought. You buy glasses, you pay for the glass companies that you bought the glasses to. If you're machines depreciate, who do you write the check to for the loss of value? You really don't. But you're required to write in the depreciations in the books, but you're not really paying someone because the value is lost. So that's what it means by non-cash charge, is that you really don't pay someone for the loss of value. Here's cash flow statement that I got from Starbucks. Can you identify which line item is the capital expenditure in this? If you can see, well, I can zoom in. Just let me know.
Change in fixed and intangibles.
Yes.
Chris, can you zoom in or like whole screen? Yeah.
With the change in fixed and intangibles part is the capex we use. I'm so sorry for my voice, by the way. It's just so annoying.
That's all good. So this. How do I? This line would be the capital expenditure that you will be able to find acquisition of fixed and intangibles. Everyone understand capital expenditure now? Cool. Let's move on to the net operating working capital. This was another part of the.
Sorry for the interruption, Chris. So just a quick check. So I put one link for Apple from the original 10K report. It's not from Bloomberg. So if you go, look at the check. I have the Apple 10K.
Mm-hmm.
I just curious whether everyone can discuss how to find out those capital investment, capital expenditure using the cash flow statement. So cash flow statement would be easier, to kind of identify how company use the money. Are you able to go to the consolidated statement of cash flows? Just a search for statements of cash flows. It will bring you there. Chris, are you able to share the screen?
Yes, give me 1 second.
Thank you.
Right here. This is the consolidated statements of cash flow, also known as cash flow statements, that you'll be able to see. This is actually from, obviously it is on Apple's 10K, not from Bloomberg. The data that I got was from Bloomberg, so let's practice on the actual 10K instead of the Bloomberg one. Again, what would be the capital expenditure line item on this?
I think it would be payments for acquisition of property, plant, and equipment.
Mm-hmm.
Or no?
So Chris, could you please zoom in for investing activities for Apple? Yeah, I know.
It completely
it happens all the time.
There you go. Okay, cool.
So then we can, analyze item by item. For example, the first one, purchases of marketable securities. That amount, does this, is this belonging to investment expenditure or not?
Right. So when Apple purchased marketable securities, can that be considered a capital expenditure? What do you guys think? Yes or no?
I mean, it could be interpreted as a long-term asset, maybe.
But does it really help Apple to do their operating business by purchasing marketable securities?
No.
Okay.
It feels more like a hedge
Right. Or an investment.
or a way to use cash, right?
It could be minority interest or investments in associates, but that's a topic for another day. Let's see. The next one, proceeds from maturities of marketable securities. This, do you think this is a capex? No, and for the same reason, this doesn't really affect Apple's day-to-day operations. Same thing could be argued for sales of marketable securities because they all deal with marketable securities. Now, here, payments for acquisition of property, plant, and equipment. Do you think this is capital expenditure or not? Anyone? Yes, no, maybe?
Yes.
Yes, it is. It's the as we mentioned, capital expenditure is mostly property.
Sorry for the interruption. So proceeds from sales of marketable securities, does that belong to, is that belonging to the capital expenditure or not? So the first three items.
Right. But we all said it shouldn't be.
Yeah, correct.
And that's because it doesn't have impact on day-to-day operations of Apple.
Right. Thank you.
Could we talk one thing really quickly about proceeds from maturities of marketable securities versus proceeds from sales of marketable securities? I'm interpreting it as like the total value versus like what was actually sold. Am I interpreting that correctly?
So if you're not sure about the item, so below this one, yeah, they provide very details about the notes. The notes on the financial statement. And the marketable securities typically refer to the common stocks that they purchase. And sometimes will be marketable debt instruments. They also purchase derivatives. So they do hold lots of derivatives. And so those are called marketable securities. And if you look at the items, they also have so-called non-marketable securities. And most of the non-marketable securities belong to, for example, government-issued bond. But so it's over the counter. For example, it's not traded in the exchange market. So it's non-marketable securities. So all those items. But you can look at detail for that discussion. But all of these belong to cash or cash equivalent items. So it's it's just like cash relevant, securities. So not directly related to the operations.
Right. To add on to that, Joe, we talked about hedging earlier and how companies hedge by purchasing derivatives or forwards or futures of a commodity. This would be part of it. If they held it to maturity, then it's proceeds from maturities because they matured. Same thing would happen to debt if they hold any debt of another company, if they issued any debt, and if they held it to maturity and got the par back, then that would be a maturity. If they sell it before the maturity, it becomes sales of marketable securities. This could be also stocks if they sell stocks after a certain amount of investment, and if they think they got enough capital gains from it, there'll be sales from marketable securities.
Thank you for that. I get the distinction now. Cool. Thank you.
For non-marketable securities, we need to pay special attention on it because sometimes, especially the high-tech company or pharmaceutical companies, they tend to purchase some shares. They just do some like private equity investment. Okay, they are not directly, invest in the machine, the property, but they invest in another independent research, team, for example, research company. And for that sense, it really depends on, the detailed deal. For example, do they only get the proceeds, like dividends? Okay, if they only get dividends, we may not treat it as capital investment. But if they, can benefit from the outcome of the patent, so on and so forth, then we can treat it as all the R&D, outcome. Then we can treat this as capital investment. So that's why sometimes you do need to look at the notes to understand what they really spend on, what they can get from this. So the capital investment, typical view as something that you invest, you invest today, and in expectation or in expect to get the long-term benefits, not like holding the asset, holding the securities for only for 6 months or 9 months or a year. And also we always ask us whether this investment is related or benefit the company's long-term business strategy or something like that.
Great. Thank you, Kathy. I think we're ready to move on. Just kidding. We have one more line item left. So payments made in connection with business acquisitions. Do you think this belongs in capital expenditure or not? We really haven't touched this yet, but what's your gut feeling? Yay, nay?
No.
Right.
Doesn't
And
affect day-to-day operations.
exactly. Apple's not a M&A company. they don't earn money by acquiring other businesses.
So excuse me, why this amount does not related to capital investment?
Wouldn't
I would trade,
okay.
but
Okay.
it really depends on depends on the business acquisition.
I guess
mentioned,
what kind of business they acquired would heavily impact
Exactly.
the calculation on the capital expenditures. So I guess that's my fault for just not highlighting
Right.
that.
So just as before, sometimes they invest in those independent startup. Okay, then if they have a very large amount of shares, percentage shares, they just treat it as business acquisition. But I agree, just check the detail. But in general, I would take this one more serious than the
Yes.
non-marketable securities.
Mhm.
If you check the IT companies, most cases you will see the business acquisition part, but this part also, this part can vary dramatically. For example, for Apple, you can say in some year they invest a lot, but in some cases they don't invest much. So you have to so-called normalize the number because it's really hard to predict what they are going to do next year. So that's why you need to go back to read the company's business plan to see whether they have some idea of, entering into different field or expand the research, building some partnership with third parties, so on and so forth. So this can help you to kind of project the acquisition plan or their potential, potential capital investment in the next year. But this item, it's very, fluctuating. But try not to ignore this one. Yeah, do not downplay this one.
Exactly.
So if you do separate work using 10K only, sometimes or in most cases you will get different number from Bloomberg. That's why I always want students to know about 10K, because we don't know how Bloomberg come up with the capital expenditure number, because every item, just like we discussed together, there is no easy yes or no. We still need to do some efforts to read through the explanations, the details, use our judgment to conclude whether this is classified as capital expenditure or not.
Exactly. Even when we look at this again, for the 721, this may be one company or like three companies, and even in that three companies, one may be related and two may be unrelated, and that is extremely subjective. That's why Bloomberg data and our data might not match, or the 10K data might not match. That's something to keep your eyes open to. Let's move on to the operating working capital. So what's the definition of net operating working capital, or net working capital in general? This is slightly different in nature with capital expenditure.
It's for the short-term expenses. It's like we are looking if companies meeting their short-term expenses.
Exactly. It's the short-term expenditures that a company spends on their daily operations.
The current assets minus the current liabilities.
So again, similarly, what's the significance of that operating working capital for the company? What would be the implication of an increasing in net operating working capital or a decrease?
I don't want to be the answering.
I know. I might call on someone.
Okay.
Nee, what do you think if you're there? Nee, are you there? I guess not. Thomas, what do you think?
I'd say the significance for this. I'm not really sure. I feel like my best guess would be that like a higher working capital means that the firm has less expenditures. I'm not really sure.
Right. So since net operating working capital is current assets minus current liabilities, higher net operating working capital would mean that they have higher assets than higher liabilities compared to the last year, which means that they're able to generate more assets than liabilities. Vice versa, lower net operating working capital means that they had to generate, or they were generating more liabilities by operating than they did for the assets. So since this net working capital is current assets minus current liabilities, higher net working capital means more current assets or less current liabilities. So when we do our valuations, we use net operating working capital, not net working capital. Do you know what the difference between those two is and why we use operating working capital?
Because operating excludes the marketable securities and other short-term investments.
And what else does it exclude? You're right on the asset side, but we also exclude something on the liability side.
Long-term debt?
Nope. Other debt.
Yeah.
Non-interest liabilities.
Non-interesting or not interest-bearing liabilities, which usually is short-term debt.
Oh yeah.
It's because they don't have any interest left because it's usually the last term. It's the last 12 months of the debt. So now that we defined net operating working capital, why do we use it over net working capital?
It'll provide insights into any changes for operating cash flows.
You're on the right track.
In accounting period, like it shows what happens in that accounting period.
But net working capital will show the same thing. We're just taking out two line items. But why are we taking out those line items?
Are we trying to focus more on the long term?
No, because net working capital itself is short term in definition. And longer term we'll cover with capital expenditures. The reason being is that cash, well, I should say excess cash and short term that are financing decisions. That does not impact the operating of a company. Because holding more cash than needed or taking on shorter term debts that does not bear interests is ultimately a financing decision of a company that really does not impact the operating cash flow of a company. And because what we want to measure is the operating cash, we want to be as precise as possible with the calculation of net operating working capital. This is why we take out cash on the current asset side and short-term debt on the current liability side. But before I proceed, I want to check with Kathy that what I said was correct. Because I'm pretty sure this is how I learned.
Yeah, I think you said correct.
Okay, cool.
I think the easy way for us to understand this item again, maybe try using Apple's 10K.
Right.
Then find out that one is a little bit difficult. How to find out the net operating working capital.
Right, and it takes a lot more steps than CapEx.
Yeah, for that one, there are some items are arguable. So let's go back to the 10K.
Oh, and
then you can then Chris mentioned the cash, short-term debt. Those are definitely financing decision. So it's related to financing activities. It's very important.
Yeah, before we proceed, this excess cash, it's usually about 5% of the company's revenue. But don't take my words for it because it really depends on the industry, the way the company operates. And the reason why the net operating cash working capital will differ in the cash flow statements versus what you calculate is because we really don't have the exact measure of excess cash. So what CFA Institutes encourages you to do is to take out the whole line item of cash. But that's also not going to be the exact amount of excess cash that you're going to calculate. That's why there's difference in the balance sheet that you find versus the cash flow statement that the company releases. So with that being said, let's move on, or let's go to the balance sheet with the Apple to do the. Do we have enough on this? Yes, we do. So first of all, how do we calculate net working capital, not the operating working capital. Let's start with just the normal version of net working capital first. What was the formula for it? Can anyone?
Current assets
tell me?
minus current liabilities, we said.
So let's calculate it for 2018, the one on the left. Can you pull up a calculator and give me a number? I'm doing it along with you guys.
Which year you said, Chris?
Left one, the 2018,
Okay.
this one.
Okay.
I got 14,473.
Yes, you're correct, Nate. The net working capital for 2018 for the Apple was 14,473. We do it by taking current assets minus current liabilities here. Now let's do the operating working capital. What was on the current asset side? What number do we take out? Can anyone give me the numbers? Not necessarily the end product. Can you tell me what to do? What numbers to use?
Other current assets?
No. We still start with the current assets. What do we take out?
Cash.
Yes. How much cash do we take out?
25,913.
Yes, 25,913. And then what do we do? That was the current asset side. Now we have to.
And we go to the current liabilities.
So 116,866 minus how much do we take out?
Wouldn't it be 8,784 for the short-term debt?
Yes. It just says term debt. Is that short? Yeah, that has to be short term because
Yeah, it's current, right?
So yes, 8784. So the answer would be, did anyone follow along with the calculation?
I got 2,656.
Positive or negative?
So I couldn't really follow up. Which item you subtracted from current liabilities there?
This one, term debt.
Term debt.
Because this is current liabilities, term debt would be short-term debt.
Also commercial paper as well.
Oh, right.
Why don't they use like short-term debt? Like, why do they say term debt?
I don't know. I never realized they did that.
Like when they use different names for these items, like it's hard.
I agree. But yes, commercial paper would also be included in that short-term or non-interest bearing debt. So that means we'll have to take out two numbers from current liabilities. 116,866 minus 8784 minus 11,964.
By the way, the term debt is not equivalent to short-term debt. Short-term debt including commercial paper, including any loan that will be due within a year.
Right,
so term debt is more like a structured. So term debt is a contract with pre-scheduled payment, and those payments could be a month, could be by year. So that's why if you look at the non-current liability, they also have the term debt. Those term debt, those are the payment that will be due in years, not within 1 year.
Yes.
Oh, so you've done using the statement, the what's that, balance sheet, right? So why not to go to the again cash flow statement? Go down. Okay, cool. So if you want to find out the net operating cash flow, the easier way is to look at the first activity, operating activity. within the operating activity, the cash flow statement has already done a great job taking care of most of the items, such as appreciation, so those non-cash charge like depreciation or amortization has been added back. And they also, list some payments. So you can just go through those items to see which one you want to do your adjustments. For example, so let me say the change in operating assets and liability. There is one item. It's just interesting. Really depends on how do you view this, which is other current and non-current liability. This amount can be huge and varies a lot. And
Right
if
here.
you so Chris, can you search for non-current liability? And then it's liability. Go down, continue, next one. Next, here. So this, go the previous one, the previous search. So other non-current liability, they already list out what are the items listed here. Okay, so most of the items related to the tax, and they also have some detailed discussion about what are the liability. For example, the companies may own need to pay the corporate income tax, so that amount is treated as liability, non-current liability. This is included in the operating cash flow items. So now some people argue, this amount is not fully related to the operating, activities, because those tax part, deferred tax liability, for example, includes the tax charged on selling the marketable securities, on those proceeds, okay, on financing activities, not really related to the operations. So it really depends on, how much you want to do the, how much detailed job you want to do
Right.
to separate those items. But in most cases, it's okay. If you go back to the cash flow statements, there is another item. If you read 10K frequently, there is one item appears frequently, which is, let me say, which one? Oh, deferred revenue. So anyone knows what's deferred revenue? Then you can Google it.
Revenue that's been earned but hasn't been paid yet.
So the service has not been paid yet. Excellent.
No.
Yes, the client has already paid the money, but the service or the product has not been delivered to the clients yet. Excellent. So it's similar to like account receivable. You receive the money, but has not provided your service yet. Yeah.
And that's one of the bigger reasons why financials is so hard, because they can, well, I really don't want to say manipulate, but in reality, that's what they do. A lot of financials companies write down deferred revenues because they mostly operated by providing services, and they can.
Yeah. So so if they receive the money, sometimes really depends on the company how they recognize the revenue. Sometimes they recognize the revenue when they finish or complete their services. Okay, but from from analyst point of view, as long as the company has already collected the money, that's cash inflow already. So for finance people, we care about the cash flow.
Right.
We how to recognize revenue, that's not our job.
Exactly.
Thank you. Yeah.
Since we only have a few minutes left, I'm going to briefly touch on cost of equity and cost of debt. And I really wanted to go deep on this, but let's see. We can go until the time allows us to do. Formula for cost of equity. You guys should all know this. What do we use? The Nobel Prize winning formula that we use to calculate the cost of equity. What is it?
CAPM?
Capital Asset Pricing Model. There are other ways to calculate cost of equity, which really just branches out from capital asset pricing model, which is risk-free rate plus beta of ERP. Then how do we obtain ERP?
We need the market rate.
Yes,
And
it's the market rate minus risk-free rate, but how do we then obtain market rate? I should really.
Typically, long-term returns on index fund like the S&P 500 or something.
On index. You are correct. And what constitutes as long-term return? How many years should we really look back on this?
At least 8.
Yes. Thomas, how many years did you use for your valuation?
I think I used the 20-year.
Yes, and how many? How much was the market return for 20 years?
I want to say around 7, maybe 7, 6.5.
Right.
Like
I think it was like 7.1 if I recall correctly.
Yeah, around
so
there.
I think that's about the sweet spot. I think 20 years is sufficient. You'll get around 7 to 8%. Really depends on how many years you use. It will slightly make a variation on the equity risk premium that you will use, but usually it will fall around 7 to 8% on market return. And risk-free rate is observable every day, so that's something that you would use 10-year or 30-year, depending on your forecast horizon.
Do you think this is a reasonable rate, though? Do you think this is a reasonable rate? Like, is it around this like 7-8% right now?
Right now it probably wouldn't be, but we're also forecasting a long-term return. So we also think that in a longer-term view, this market will not last forever.
I agree with Chris. So typically we are not going to use current market return. If you are use current market return, imagine that we were in 2007, 2008, 2009, right? Then the market for that year is negative. Are you going to use negative, rate as the long term as the cost of the equity? Absolutely not. Remember, we just try to find out what's the cost of equity. In other words, if the company want to raise the money through the equity or security offering, what's the cost related to that? And the cost depends on, the required rate of return by investor. So the 7% or the long-term return typically capture the required return by investor. So if you are the investor, you purchase Apple, you require Apple will generate at least positive or even like 7 or 8% return. That's the reason you buy the stock.
Mhm.
If the stock will, if you know for sure that the return on the stock will be lower than the inflation rate, will be lower than the T-bill rate, then you will never invest in stock. So that's the concept of cost equity. But of course, that return really is different from so-called realized return.
Mhm.
So the long-term return is the best estimate statistically, is the best estimate for the expected return. It's not equivalent to the realized return.
Right. And as I mentioned, there are some varieties of cost of equity, like you would add size premium to this, and then value versus growth stock premium here. It's you could really make a multi-factor model out of CAPM, but this is what we generally use, and I don't really require or see us having to use size premium and value to growth stock premium in the Red Hawk Fund valuation, because we usually deal with large cap value stocks. I do want to stop here because we are past 5 p.m. here. I really wanted to cover cost of debt, but I'm sure we can do this another time. After maybe we get the new members in for training, we can use this material again. But thank you all for joining today. I hope you have a great week, and I'll see you next week.
Yeah, thank you everyone. I like the discussion very much. I also add one more link for you to check, which is the implied market risk premium. So there are different ways to estimate the market return. So I add this one for you so you can check. Thank you. I really enjoy the discussion.
Oh,
Hey,
by
can
the
I
way,
share some? Oh, go ahead.
no,
Just
before you all leave, I have an announcement, a quick one about a guest speaker that we're going to have on June 2nd, which is the new revised time that we came up with because March 31st is a holiday. That's another announcement. We'll be inviting Matt, who was a former Red Hawk Fund chair, to our meeting to discuss, or for him to present about his experiences as a Red Hawk Fund chair and how he now is a venture capital or analyst. So
Junior partner.
Junior partner. So please come in and join us for his presentation and ask questions for him. Announcement and me, what were you gonna say?
I just want to share this thing really quick with you all. So this Wednesday, May 19, we have AMA. So we have 4 organizations in Albers: American Marketing Association, Management Advancement Club, UGL is undergrad leadership, and Women in Business. We have this workshop, part of the Spring to Success event, and this was the best investment. It's not like investment like equity investment, but it's more investment and professional development. And we invited Janani Sundaresan. She is an alum of SU, class of 2018, and she was the president of SU AK Psi. It's a business fraternity, and she also a financial analyst intern at Amazon, Liberty Mutual, Microsoft. And she's a member of the finance rotational program. She just graduated from that program and current business due analyst of Microsoft Devices team. So just want to invite you all, if you're interested in getting into a career in finance or want networking with Janani, ask her questions, feel free to come, and I can email you all, like just text me if you need a Zoom link, but it was posted on a lot of club social media. So it would be great if you all can come and hang out. Yeah, so that's just my one last thing.
Great, thank you. So yeah, thank you all for joining today. This will be on YouTube. I will upload it soon. So please be on the lookout for that as well. But thank you for joining. I'll see you all next week.
Thank you.
Thank you, Chris.
Bye.